we're going to focus on one element, which is from a policy perspective and then from a market performance perspective. I've been challenged to make this presentation as simple as possible, and I hope it turns out that way. So from what we're essentially saying now is that we've reached the end of a decade, essentially 10 years, and we're beginning a new era, another decade. And it's important that we reflect on some of the key events that have taken place over the past 10 years. And we note a couple of them. I think now we can safely say, with the benefit of hindsight, that from the past decade, 2019 turned out to be a very good year from a risk asset perspective. And 2018 was not a particularly good one. I think a number of you will remember when you're looking at your returns over the calendar year 2018, they didn't look so good. So there was quite a lot of anxiety of what 2019 was going to bring. And there was quite a bit of a turn in terms of the performance there. You look at the performance of the S&P 500, which is normally used to measure equity market performance in the US. It's done very well. And even just globally, you look at MSCI, all country index is done very well. Since the 2008-2009 global financial crisis, it was a decent growth that we have seen in the past 10 years, from about 4.5% the previous decade or pre-recession, and then post the global financial crisis, we have seen growth of about 3.8% from 2010 to 2019, which we think is quite decent growth, although it's still below the pre-recession levels. Having said that, there are a number of issues that has supported this growth, or what we have seen in terms of market dynamics as well as major macro news, that have resulted in the growth that we have been able to see. Inflation is very low. In fact, it's at the lowest it's been in a number of years in a lot of countries as it is now. Excess savings, they're leading to lower nominal growth. This is particularly in reference to the US. American home prices, which is really where the epicenter of the GFC, I'll keep mentioning the GFC, which essentially is the global financial crisis. They were the epicenter of this crisis, and they have since started to recover in a very decent way. Unemployment levels have dropped quite substantially, particularly in the US, and they are now near historic lows, and this is for most developed markets anyway. And then it's also a more favorable position for households in the US, where we saw this global financial crisis starting. They are now net savers as opposed to pre the financial crisis, where they were essentially on a net debt position. So part of this shift to a credit sobriety of some sort, it is part of the reason why we have seen growth not coming as strongly as a lot of people would have wanted it to come. And there are also unorthodox measures or textbook macro measures that a number of central banks have now employed to try and rejuvenate the growth from a global perspective. So each and every policymaker is focusing on their area to try and improve or rejuvenate growth there, particularly coming from a crisis position. This is what we have seen happen in the last year, and the asset prices themselves are holding strong, particularly in the real estate sector. And we think, coupled with growth that we're seeing happening from a global perspective, this is a good sign. But it has not been a walk in the park. And 2011, just as a quick reflection, the ECB, European Central Bank, President Jean-Claude, raised policy rates. So 2011 was just after the recession, and growth seemed like it was coming back. The Fed Reserve as well said they were not going to be left behind. It's always interesting to see how all these policymakers make their decisions, because it's like they communicate with each other. But you will realize in the next few slides that all of them sort of make decisions that are centered around what the other is doing, just to make sure they are all synchronized in the thinking. The Fed Reserve Chair, Ben at the time, prematurely ended the balance sheet expansion, which was commonly referred to as quantitative easing, which was another measure to try and bring back growth yet again into the economy of the US particularly. China also said we're not going to be left behind. The fiscal and credit policies moved from a massive stimulus in 2009 to a major restraint in 2011. And this is really where the headaches then came from. Shortly after that, there was a rapid slowdown in the global economy from a growth perspective, and we saw the onset of the European sovereign debt. You remember those days where you didn't want to hear Greece. And this is around that time when all these things were happening. And fast forward a couple of years later, in 2015, again, we're still looking back in order for us to look forward here. The Fed raised rates. They ended their balance sheet expansion. China as well, they cut rates, but at the same time, they shrank their balance sheet. So sort of like a neutralizing effect, if you look at that. That resulted in combined, if you look at it, it's resulted in probably the biggest commodity bust in 8 years. That is around the time where we also saw a US profit recession, shortly after 2015 there. All of these put together, including the recent fight or trade war, as it's commonly referred to, between China and the US, resulted in a protracted global economic growth recession, particularly in manufacturing. The Chinese authorities as well, they've announced a number of measures that are really aimed at counteracting the growth or the slowdown in growth that is seen in their region in China. And more recently, another challenge that has been thrown into the mix is the coronavirus. And typically, the China-US trade war as well has come in, to contribute to some of the slowdown there. The key lesson that has been instrumental to all of this, arguably being the successful investment strategy over the past decade, is that you don't fight the policy authorities. They commonly refer to it as don't fight the Fed. So from a market perspective, having dealt with policy, emerging markets have not had a phenomenal decade as it was previously before. Now, to a great extent, this performance, as I've already indicated, it has come from policy decisions. It has come from what has happened globally from a growth perspective. And one thing that we ought to note is that there's no decade that is the same. We should not look in the rearview mirror to try and think about the same being repeated in the next decade. So every decade, in our view as a firm, is that it does tell its own tale, and market leadership is normally different, in each and every decade. It's actually quite interesting when you look at some of the relationships that are there from a decade to the next. But venture capital performance, I've picked it particularly because it's the best performer over this period. Emerging markets, the worst performer over this period that we have highlighted, which is the most recent decade that we are coming out of. So when you look at the decade before this one, in 2000 to 2009, that was when we were talking Y2K, where it essentially the beginning of that decade was then the tech bubble. Previous to that decade, it was the emerging market crisis, where there was essentially within emerging markets, it was one market after the other. It was an Asian crisis, it was a Russian crisis, and their currencies as well. And then shortly after that, we got into the tech bubble. And this decade, it was defined by markets allocating more and more towards capital or venture capital and private equity. It became more attractive as an asset class or as an asset allocation tool as compared to emerging markets. So emerging markets did not do well in the previous period. And then as we go into this decade of 2000 to 2009, late in that decade, 2008, 2009, the global financial crisis happens. Investors lose patience, and then they flock back to EM again. Because remember, a lot of this GFC came from the developed markets. So investors were not thinking of going back to those guys who caused the crisis that we were in at that period. So they then shifted their capital towards emerging markets. And during this period, or this particular decade, 2000 to 2009, emerging markets did surprisingly well compared to the private equity or venture capital asset class. So essentially, they just shook off the negative sentiment that was there in the previous period. It is not necessarily true that what happened in the previous decade will be repeated in the current decade from a performance perspective. So emerging markets attracted capital in the previous decade. They did do quite well, and then started to feel the effects of the global financial crisis. We know that emerging markets were some of the ones that got impacted quite negatively over this period. And then where do we go? We then get to a point where private equity is the one that has done quite phenomenally well over the past decade, 2009 to 2019. And then you look at where the emerging market asset class is. It has not returned quite well for investors. So annualized numbers over the period, emerging markets as an asset class has done just 4% per annum. And then you look at the asset class private equity, wouldn't we all have loved to put our money there? It's done 23% over that period. It's always good to have these discussions now with the benefit of hindsight, but navigating the decade is another job altogether. So where are we now? Technology, innovation, these are some of the assets that are doing quite well, or securities that are doing quite well. There's top of disruptive kind of investing in the markets. We're talking all these things that are very good from a flavor perspective, but it's always a question of, but are we allocating capital to sustainable things that we think will generate performance over a period of a decade? If we have an outlook of a decade, or are we necessarily just allocating capital to a particular instrument or to a particular idea just because we think it is quite interesting and intriguing? So markets are at the moment actually financing some of the most disturbing ideas out there. Some of them very credible, no doubt, but some of them very disturbing and essentially just saying there is no sustainability in how we allocate money. There's talk of disruptive investing, but where is emerging markets in all of this? Emerging markets have not done well in the previous decade. They did phenomenally well in the decade before that one. So could it be their time again this decade as we're looking out another 10 years? One very critical element which has defined how things have been or how things turned out which will make us think about our vision to 2030 again, or the next decade, is the US trade policy, particularly given the trade war with China. So I've put this up because it was a dominant feature, and if you look there in around 1994, 1995, when there was talk, or the 1990s simply put, when there was talk of NAFTA, there was a lot of uncertainty. So this graph is simply showing you US trade policy uncertainty index. How are investors feeling? How are manufacturers thinking about trade? Are they optimistic, or are they very jittery about how things are going to turn up? So there was quite a lot of uncertainty during this period. And if you look at this chart now, this is the trade policy of the US and China now. More recently, how are people feeling about it? That index just shows you that the level of uncertainty, it is twice the level of uncertainty that was there around NAFTA. NAFTA was not a bad deal in how people look at things just generally. But now the war between US and China at the moment, looking at globalization and anti-globalization kind of practices, looking at Brexit now also making the equation. How are we thinking about these things? How are they likely to impact things? Well, we've already started to see PMIs that are in recession, or manufacturing indices that are in recession. So inflation has been arguably low, particularly because of globalization. The level of social expenditure is going to increase. But the debt to GDP is already very high. Just recently, South Africa came out of its budget, and the debt to GDP, 70-odd%. Quite interesting times. Botswana, it's increasing for us as well. It's not getting any easier. Growth is not coming around. The US, I don't need to mention. A lot of these economies, debt is essentially just swelling up and swelling up. Let me just share with you what my thoughts are. Emerging markets, private equity, next decade. I realize the suspension might not be bearable for all of us to be here again in 2030. Whose decade will it be? The base view at the moment is that emerging markets should come back. Why do we think that it's time for emerging markets to come back in this decade? It's particularly because when you look at the valuation of emerging markets, very attractive relative to where everybody else is. But more importantly, compared to the private equity asset class, there's a lot of dry powder. Dry powder, in this case, we define as money that is waiting to be allocated in private equity or venture capital. It is sitting there idle in the market. So if you go to Economics 101, it says the law of supply and demand. When do prices go up? But in this case, we're saying that the markets are flush of capital as far as this particular asset class is concerned. So before you think about going to increase the allocation to this particular asset class, by all means, I'm not discouraging. I see asset consultants are looking at me, but it's really just to think about the level of the dry powder that is there and its implication for performance. With that having said, remember the decade that we're coming out of just now. The emotional scale for a typical investor. Emerging markets have been on the wrong side of that. Maybe it's time things changed. And it does look like with a weaker dollar, emerging markets will do well.